Hi everyone, so this is a really important lesson on the long run Phillips curve. Any essay that you see which is about unemployment and inflation is going to be asking you really to focus on the Phillips curve. So let's just have a little look at what we've got. We've got some key terms that I really want you to take away from this lesson, as well as an understanding of the difference between the short run and the long run Phillips curves. Okay, we're going to begin again here with our classical long run aggregate supply model, where we've got aggregate demand and aggregate supply, short run aggregate supply curve denoted there. Let's just highlight our price level here. So we're at the moment on P1. Okay, if we just highlight point A, the economy is actually in long run equilibrium here, a situation of full employment. Okay, that situation of full employment means that everyone that wants to actually get a job can find a job, but there is always, of course, a level of frictional unemployment within the economy. That level of unemployment can be quite useful because it helps to ensure that labour markets don't become too tight, which would really drive up wage levels, for instance. Okay, so we've got that sort of scenario playing through there. Now, of course, classical economists believe that the economy will always revert back to a situation of full employment on the long run aggregate supply curve, and this gives rise to the notion of the natural rate of unemployment, NAIU, which I've just denoted down here. Okay, and this is unemployment when the economy is in its long run equilibrium. Okay, so we could also put down that this is our natural rate of unemployment here at YF, or full employment. Okay, so let's now just take this notion of what we have here across to our Phillips curve. So if we put in our Phillips curve, we have our short run Phillips curve here, and then take across our current price level, well, we can see where we currently are at point A. Now, point A gives rise to perhaps a 2% level of inflation and a 5% level of unemployment, let's say. Okay, so I'm just going to take this point up here as well and draw a vertical line like so. It'll become quite clear as to why I've done that in just a moment. Okay, so the scenario here is once again that 5% corresponds exactly with what we've said here about full employment or the natural rate of unemployment. So therefore we are on our natural rate of unemployment, the NAIU, at 5% in the economy. Okay, so let's now just consider the impact of a decision by the Bank of England to reduce interest rates, which would generate an increase in aggregate demand, or alternatively an expansionary form of fiscal policy through government expenditure perhaps. Well, that would generate an increase in aggregate demand. Aggregate demand would shift to the right hand side, and yeah, we can see that nicely from AD1 to AD2. Now, of course, we can also see that the economy is going to transition to a point of higher economic output, but also higher prices. Now, I'm just going to call that point B there, and we can see that we actually have an inflationary gap in the economy. So there's an inflationary gap, and we are beyond that level of natural rate of unemployment in the economy. Okay, but we can also see the price level has increased, and if we take this price level across, then we can see how it corresponds to what we also see on our short run Phillips curve. Well, perhaps now unemployment has been reduced to 4%, and the economy has moved up our short run Phillips curve to point B. Okay, now we also see that this corresponds with price level point P2 here and output level of Y1. So just be aware of what we also note here. We see output of real GDP beyond full employment, so therefore we expect a lower level of unemployment. So yes, we've gone from 5 to 4. Okay, we also expect that prices have risen. which they have. So we can see a higher level of inflation here on our Phillips curve diagram. So perhaps inflation is actually 3% in the economy, and unemployment is 4% now. Okay, so the issue now becomes what happens next. Okay, so firms have decided to increase output in response to this increase in aggregate demand. They've increased the number of hours of work on offer. They've perhaps employed more staff as well. And as a direct consequence of that, we can see that real GDP has increased. Now, the question then becomes, though, what about the labour market there? Do employees in the labour market actually understand that inflation has also risen? Do their expectations adapt, in other words? If they do not have those adaptive expectations and they see perhaps their higher nominal incomes as higher real incomes, then actually they're suffering from a concept known as money illusion. And this is where people have an illusory picture of their income, which is based on their nominal income rather than their real income. So perhaps given that they might be working longer hours, they're getting paid more, and that may lead them to actually believe that they're actually better off when they're not actually better off. Okay, so the question is, do they really adapt their expectations to combat that higher level of inflation? If they do not, then the economy would simply, in the longer term, just revert back to point A. Okay, revert back to point A on our Phillips curve as well, and respond back to that natural rate of unemployment of 5%. Okay, or back on YF here at point A. Okay, now if that, however, they actually adapt their expectations and they demand higher real incomes, then we would see a shift in the short run aggregate supply curve. And the short run aggregate supply curve would shift to the left, and we can see that here. And what is also worth noting is obviously point C back on our long run aggregate supply curve. Okay, so point C again corresponds to a higher level of inflation. Okay, notice what I've just done there. I've just taken that across to tally up with this vertical line that I drew earlier. Okay, so now we're at point P3. We have that higher price level, but we're back at a 5% level of unemployment. What's more, real GDP has actually reverted back to this point in level in line with our natural rate of unemployment on the long run aggregate supply curve. And as a direct consequence of this leftward shift in the short run aggregate supply curve, we have a rightward shift in our short run Phillips curve. Okay, so we're now on short run Phillips curve 2. Okay, and we of course have now jumped onto point C there, where we have a higher level of inflation, which is perhaps 4%, okay, but a natural rate of unemployment persisting because the economy is back at its long run equilibrium of 5%, okay. So what we in essence see is a vertical line, and if the economy then decided to have another fiscal stimulus or another monetary stimulus, aggregate demand would shift up once again, and then we'd be on a short run aggregate supply curve. Then we might revert back because of those adaptive expectations, and all in all we keep going straight up this line. So what we in essence have is our long run Phillips curve, a long run Phillips curve really denoting where the economy will be and the corresponding level of unemployment and the inflation level. Okay, but what's also very, very important to note here is that from A to B, prices are rising, prices are accelerating, inflation is picking up as it is from point B to C. It is only when we are on point A or point C there that we are actually on a non-accelerating inflation rate of unemployment. Now that non-accelerating inflation rate of unemployment is the level of unemployment sustained without a change in inflation. Okay, we can see that as soon as we deviate, we can see that prices begin to rise. once again, prices begin to rise. Okay, and we can see that here, that inflation picks up. So the real question then becomes, right, well, how do you then manage the economy bearing in mind the findings that we see here? Well, it's obviously going to tip you towards looking at supply side policies as a means of fostering long-term economic growth. We can see that actually increased in aggregate demand, as the classical economists believe, do not increase the long-run aggregate supply curve and do not lead us to actually deviate from that natural rate of unemployment. So therefore we need to look at supply side policies to shift this long-run aggregate supply curve if we actually want to reduce unemployment and inflation in the economy. And we'll look at that in our last lesson on the long-run Phillips curve and the Phillips curve in general. Okay guys, hope that's been useful. Thanks ever so much for tuning in. See you next time.